So Brian, a fair bit going on in this result, but firstly on the headline numbers, cash earnings down 15% and the dividend lower for the first time since the GFC. Obviously there's a range of headwinds facing the industry, but walk us through how you saw the past 12 months.
Yeah, it's a challenging result that reflects a challenging environment. A number of things here. I think clearly low interest rates, particularly in the second half, has been very challenging. Essentially, low rates are a drag on what we earn on deposits, and that puts a squeeze on our overall margin. We've also seen pretty low credit demand, which has meant that the normal growth that we get out of the balance sheet hasn't been helping us there. And then for our result particularly, we've obviously had big remediation provisions that we announced in the first half around the exit of our advice business and the costs associated with that, as well as the customer remediation. We've had a bit more in the way of customer remediation provisions in the second half. And that just fundamentally reflects the desire to address any of these historical issues that we've got and deal with them as quickly as we can. There have been a lot of costs associated with that, and we're having to invest pretty heavily in our risk and compliance systems to make sure that they are up to the standards that the regulators now expect.
Now that sort of brings us nicely to the capital raising and the dividend. Was it the case that essentially the payout ratio just got a little too stretched in an environment where capital rules were tightening, or is there sort of something else going on?
I think there are two broad issues, although of course they're related, the capital raise and the dividend reduction. So on the capital, it's a funny one because we feel that we've got a lot of capital and are well capitalized. At the same time, we've had a number of changes in the way the regulators assess the capital ratio. And we've had the cost of customer provisions, which have obviously been significant as well. Those things combined meant that although we were above technically the unquestionably strong benchmark that APRA has set, we felt that we didn't have enough buffer there in case there were further changes in the capital ratios, further legal or regulatory actions and the like. And there's one thing that's just non-negotiable for Westpac, it's that strength is our starting point. We always want to be in a position that if the economy turns down, we can continue to do our job and lend into the economy. And so we just felt it was getting a little tight in terms of the buffer of where we wanted to be, and that drove the decision that we should raise some capital. Now, having done that, and with, at least for a period of time, some ongoing pressure on earnings, we've always had the goal of getting the dividend payout ratio into a sustainable range over the medium term, which we felt was probably around 70 to 75% in this environment. And we felt that rather than continuing to rely on increasing shares to pay the dividend, with earnings under pressure for a period of time, it was sensible to make that change. Now, it was a very difficult decision because we know that a lot of our shareholders rely on the dividends, and we want to continue to pay those dividends over time. And when our capital position hopefully improves through earnings, we'll be very pleased to be able to increase the dividend again from here.
Now there were some other fairly notable announcements today also. So firstly around the NPS goal, which almost feels like a bit of a sign of the times given it's a non-financial metric, but how did you come to choose that metric as the key goal for the company going forward?
Well, internally we have used Net Promoter Score as a key measure of our success across all of our businesses for a long time, for many years. There is no one perfect measure for customer satisfaction. Believe me, I've looked at them all over time. But we feel that on balance, NPS is the most nuanced measure because it essentially takes into account both the people that are advocates for you and the people who are detractors for you. You'll recall from our earlier conversations that our objective is for Westpac to be one of the world's great service companies. And we have put tremendous effort into building a service ethos in the company, in fixing the root causes of complaints, at getting better at dealing with complaints, at building strong brands that are focused around helping customers in the moments that matter. And so we felt that it was an important external promise that we expect people to be able to measure the delivery of that service strategy externally by us reporting on NPS. So it was kind of as simple as that. It wasn't really a fundamental change. It was a belief that if we're serious about this commitment to service, then we need to be willing to go public and say our objective is that we will have the highest NPS scores. We already do in business. In consumer overall, it varies a bit by brand, but we're number 3, although we've closed the gap to number 1. So I feel it was a way to galvanize the organization around, we're putting this out there publicly, we need to deliver on it.
And the digital banking platform, which looks like it will involve working with 10x, the cloud operation of former Barclays CEO Anthony Jenkins. Talk us through how this banking as a service idea will work and how it sort of differs to other digital bank strategies we see out there.
Well, the context to this is it was clear to us going back 5 or 6 years ago that the banking environment was changing quite dramatically, and we needed to reposition through our technology investments across the company, Westpac, to prepare for this digital future. Part of that involves partnerships. So the way that I like to think about it is that being a truly digital ready bank is about more than having a cool app, because apps can be copied, customer experience can be copied. It was really about thinking as, of course, you need to have that great customer experience, absolutely, but you also need to be set up to both run yourself in a digital way internally, but also to partner with some of these new fintech companies and new services that we want to make available to our customers. As we looked at this, we felt that while we are making great strides in modernizing our internal systems, there is a level of competitive urgency about being able to put different propositions into the market. We've been very successful in some of the arrangements we've built with new fintech companies through our investments through Reinventure, and also some direct investments that we've made in things like Zip Money and the like. The 10x platform is a ground-up modern banking platform. It's relatively narrow in terms of what it can do today, but we feel that it is robust enough that it gives us the ability through partnerships to begin to extend our banking capability beyond what we do in our core business. And in the long term, if that platform proves up the way we think it may, it's potentially something we can fold back into our own core operating environment and thereby help us drive our own cost and flexibility into a better direction.
And back onto the result, it looks like mortgage growth, as we know, has been sort of hard to come by given the competition out there. But on the demand side, are you seeing any turn in that given the rate cuts we've seen this year?
We have seen a turn in the housing market in the major markets, so, but the volume is still relatively low. What we've seen is that the supply imbalance that emerged last year is beginning to come off. Investors are returning to the market, and so you're starting to see prices get bid up at auction and the like. However, the overall volume of sales is still relatively low, but nevertheless that's positive. We've also seen a lot of refinancing activity in the market as rates have fallen, and as different banks, including us, have dealt with new regulations, that's created some opportunities in the market at different times for different players. That hurt us in the fourth quarter, so we, in making some regulatory related changes, we had some challenges in the way that we implemented that. It caused, we basically put a system out to brokers that they found very difficult to deal with. That saw them shift some volume away from us for a period of time. We've now fixed that tool, and so we're seeing the volume come back. But our ambition over the next 12 months is to get back to growing at around system rate of growth by the end of the year.
And speaking of interest rates, obviously there's been another inquiry announced into pricing. But how are you finding this dynamic where banks are being urged to lend more, but at the same time there's quite a lot of scrutiny and even criticism of the industry?
Well, it's interesting, and we have conversations with both sides of politics, and it's very clear that they want to make sure the banks can continue to lend, as do we. I always remind people we're open for business, we make money by lending, we want to lend, but certainly the regulatory scrutiny that we've had from a number of quarters has been challenging to deal with. You know, I think we just have to work through this phase and stay focused on what we're trying to do, which is encourage customers to grow and to invest and to remind them that we're here to support them. And in the short term, process changes have made it a little more difficult, but over time we'll work through that.
And just on asset quality, it looks like there was a slight uptick in delinquencies in the mortgage book, but overall in the portfolio, credit quality, I mean, the bad debt charge is still very low. Is anything out there sort of raising any alarm bells for you?
I wouldn't say there are alarm bells. I'd say the credit quality is still very strong. The provision rate is really incredibly low by world and historical standards. We saw a modest pickup in delinquencies in mortgages. That's predominantly because it's taking people longer to sell their home when they get into a bit of trouble. And if you think about the delinquencies are a flow where you have new loans coming in and old ones going out, it's taking longer to get the old ones out, and so the delinquency rate rises. I think we had only one significant individual provision across our whole corporate and institutional book, so that's very, very clean. Likewise, in SME and commercial, it's really our customers are still in very good shape. There's a little bit of stress we've seen in retail trade, not surprisingly. In the auto industry, we're a big lender to dealers. Auto dealers are doing it pretty tough at the moment, so we see a little bit of that. We're obviously watching the farming situation closely, although our customers are hopefully feeling very well supported by us. We don't have any fundamental concerns, but obviously the drought is creating pressures on a number of farmers and on regional towns, and so we're monitoring that very closely. But I think that's just something we have to ride out.
If you turn your mind to the macro environment, obviously banks' leverage plays on the economy. Are you getting the sense that stimulus from rate cuts, tax cuts is starting to come through and the outlook might pick up next year, or do you think policymakers have a bit more on the stimulus front to do?
We're certainly seeing some benefit of that. I think the rebound in the housing market, inevitably you have to attribute some of that to lower interest rates and level of confidence around people's tax position and the like. But certainly, if you look at the components of economic growth, consumer spending is still relatively low growth compared to what it's been historically. Business investment is very low, and I think that's the major issue for the economy. Government spending, particularly on infrastructure, has been very supportive, as has the royalties from mining exports. So the way we see it is that overall the economy is going to continue to grow, and growth will probably increase next year a little bit. But it's a blend of relatively strong on mining and resources, government infrastructure spending, but relatively low on the consumer and business sector. So what we really want to see is government maintain that continued investment because it's important to growth, but also doing things that encourage businesses to invest, because ultimately we need businesses investing to drive growth, to drive in the private sector, to generate tax revenue, to allow governments to continue to spend.
Because I guess we're seeing the limits of monetary policy at the moment. I mean, we're kind of getting to as low as we can go.
It's certainly getting very close, and I think there is some question. We've seen some coverage and speculation on this, and it's certainly anecdotally consistent that customers are saying, well, gee, low rates isn't necessarily going to encourage me. It might tell me that maybe things aren't as good as they ought to be.
Thanks for joining us, Brian.
Thank you.